Hello, everyone. Welcome to the inaugural MIT Sloan online program. Every month, MIT Sloan Alumni Online will bring you the latest breaking news, cutting-edge research, groundbreaking ideas, and school updates from MIT Sloan faculty, alumni, and students. We are especially excited to introduce to you today our very first MIT Sloan Alumni Online speaker, Professor Simon Johnson, who is going to lead us today in a global economic briefing similar to those he led at the IMF. Professor Johnson is the Ronald A. Kurtz Professor of Entrepreneurship, head of the MIT Sloan Global Economics and Management Group, chair of the Sloan Fellows MBA Program Committee, co-founder and leader of the Global Entrepreneurship Lab, also known as GLAB, and senior fellow at Peterson Institute for International Economics in Washington, D.C., and the former chief economist of the IMF. Professor Johnson, thank you so much for joining us today. We look forward to your talk.
Thank you very much, Renee. Welcome, everybody. So, as Renee said, I propose to handle this session rather like I used to do briefings at the IMF for the executive board and also for the ministers of finance and central bank governors twice a year. So I'll give you a baseline view of the world economy. I'll talk about what may make us adjust that view in the short term, and then I'll talk about medium-term prospects for growth and other outcomes around the world. So let me summarize with my main points, just to tell you where I'm going on these issues. And thanks very much also for the questions that you sent us in advance. Very good questions. I hope that I will get to as many of them as I can during this presentation. I'll talk for about 20, 25 minutes, then we'll have question and answer moderated by Renee. And if we don't address any salient questions, please feel free to email those to us afterwards, and we'll post some highlights, Q&A, with the recording on the alumni website. So I think the big question that many of you had is obviously what will be the effect of President Trump of the British Brexit leaving the European Union, which I think now is essentially a done deal, and also other potential populist shifts, particularly those that we see underway in Western Europe. So my bottom line is this. In the United States, I think we're swinging towards protectionism. That's a major departure from previous economic policies. The bottom line of protectionism is, as always, you're going to get less growth. That's what it does. And we'll talk about why in a minute. On the budget, of course, there are going to be some tax cuts. I think wealthier Americans will do well from those tax cuts. Based on what we've seen, based on what has been announced or what could reasonably be expected, I think the growth impact on the broader economy from those tax cuts will be quite minimal. Deregulation, obviously also being put forward as a major strand of policy. I wouldn't want to exaggerate how much deregulation there will be or how much impact it will have, but I do think it will impact the financial system. Whether or not you'll enjoy the impact is another matter that I'll talk about a little bit as we go on, and you can ask more about that if you want. On Europe, it's very hard to know what to say. Honestly, uncertainty on multiple dimensions predominates. I think the risks are a little bit more to the downside than to the upside relative to the forecast I'll show you. On emerging markets in developing countries, well, this is obviously the big dynamic of the 21st century. To what extent can some of these countries, particularly large countries like China and India, continue to converge towards the levels of income per capita that we see in the United States or in Western Europe? I think those prospects are still real. I am worried that the swing towards protectionism in the industrialized countries is going to slow down that convergence process. So we'll talk more about that. And the slightly longer perspective, but really it's just around the corner, is what will the world look like in 2050? We know there's going to be two worlds. There's going to be a rich, prosperous, relatively stable world, and we know there's going to be a much less prosperous, more unstable world. Now, how many people are going to live in each part of that world, and what are the effects of one on the other? And I'm afraid that while the prospects, if you like, over that forecast horizon were not terribly good 6 months ago, I think they have significantly worsened in the outcome of our latest round of democratic elections. I'll explain that more as well. So just to remind you, when we talk about the world economy, obviously I'm not going to talk about every single country, and apologies to important large countries that aren't mentioned. But if you look at this slide, you see that when talking about global growth, it makes sense to focus on a few places. Now, I've lined up these numbers for you in two sets of columns. On the left is GDP, gross domestic product, if we just use market exchange rates. The IMF uses a moving average exchange rate, so you're not moved around, doesn't move too much based on annual fluctuations. You can see on that measure, this is all from the October 2016 World Economic Outlook of the IMF. So that's the latest available data. By this calculation, the world economy is $75 trillion. 60%, slightly more than 60%, is in what the IMF calls advanced economies: the United States, European Union, Japan, a few other places, Australia and Canada. And just under 40% is in emerging markets and developing countries. You can see half of that, roughly, is in emerging and developing Asia. China is a very large chunk of that. India, quite small on this measure, but clearly significant for reasons we'll talk about. And I've got the other countries listed there that I'll refer to in a few minutes. Now, the second column uses purchasing power parity measure. This is, as I think you probably all know, an attempt to adjust for differences in prices. So to the extent that prices are lower in low-income countries, costs much less to have your hair cut in India than in the United States, typically, this measure tries to adjust for that. And what it does, of course, is it pushes down the relative share of world GDP in the advanced countries and pushes up in the developing countries. Now, I'm not saying that one measure is better than the other. It depends on your purpose. I think for today's discussion, this contrast is quite illuminating, because you see that while the advanced economies are 60% of the world using market exchange rates, 6% of world GDP, when we go to the PPP measure, it's almost a mirror image. The emerging markets and developing countries are nearly 60%, and the advanced economies are 40%. And you can see, obviously, where the big adjustments are. All the low-income countries get bumped up some. China, according to the PPP measures, is already the world's largest economy, larger than the European Union, for example. Now, again, I don't want to make too much out of this. The Chinese authorities themselves don't particularly like this adjustment. They don't want to be seen as quite such a large economy at this stage of their economic development. But you can see the balance of the world has shifted a lot over the past 30 or 40 years. And the question that we'll come back to is whether this will continue. Does the emerging world continue to rise? What's the dynamics there? Why might we start to worry about that? Now, here are some short-run growth projections. This is taking as my baseline the IMF's World Economic Outlook from October. So this is the pre-U.S. Election projections for various prominent parts of the world. And as I'm sure you'll agree, the election of Mr. Trump was something of a surprise, including for the IMF. So we should take this as a pre-election, pre-Trump baseline. World GDP growth has been slow for a number of years. The recovery from the global financial crisis, 2008, was a very slow recovery. These numbers, 3.1% 2016, 3.4% in 2017, they're pretty sad numbers, actually, over a longer period of time. But they're not bad relative to what we've had in the last couple of years. But still, there's anemic growth. And the United States, the lead example, 1.6 in 2016, 1.8 the way the IMF measures it in 2017. And that's a relatively positive trajectory. Euro area weakened slightly. UK, obviously at this point, and the Brexit was largely understood. So that's a slowing economy. And you can see for yourself the story from the other emerging markets. There's a turnaround in Brazil, maybe. I'm not sure that they would still be quite so optimistic. But the numbers in China, India, and quite a few other prominent places are really quite flat. Now, how should we adjust this baseline relative to, or given what we've experienced in terms of the political outcomes? Well, obviously, this is both a good week to have this discussion and a very difficult time to talk about this because Mr. Trump's policies are still emerging. And while there is convergence or similarity between many of his policies and what the Republicans in the Senate and the House want, that is not the case, I would say, for protectionism or for his measures on trade. I think Mr. Trump is going to win. I think what we're going to have is a lot more restricted access to the U.S. market. He canceled U.S. participation in the Trans-Pacific Partnership, largely symbolic at this point, but still an important symbol. The Transatlantic Trade and Investment Partnership with the Europeans is almost certainly off the table, partly because of how the Europeans are going to react to what we're doing. I do think that the U.S. Is quite likely to pull out of NAFTA. Now, there's a longer discussion about how big those implications would be, including for the United States and for other countries. But I think that would be a further significant symbol. And I think Mr. Trump has a very creative team around him who will find many other ways to restrict access to U.S. markets. This is going to slow growth. That's what protectionism does. That is the overwhelming preponderance of evidence. There may be some other consequences of protectionism. You might like some of those. I'll talk about them towards the end of my slide. But in terms of my baseline growth forecast, well, that particular impact is not going to push up what we should expect in the short term. Now, there's going to be some fiscal expansion in the U.S. There's going to be tax cuts. I really would put no or almost no credence at all in this idea there's going to be infrastructure spending. I don't see that, and I don't think that's consistent with the people who are being appointed to run the budget. So you get some fiscal expansion or fiscal stimulus from cutting taxes for wealthier Americans, corporate taxes and higher-end income tax. Monetary policy is going to tighten. The Fed has made that quite clear. They think the economy is close to full employment. They are worried about potential inflation. They will tighten sooner rather than later. Now, there's going to be a political struggle for control of the Federal Reserve. That's going to play out over the next couple of years, and we don't yet fully know the outcome. But I would be surprised if the Fed is significantly deterred from raising short-term interest rates as we head into this year, particularly if there's more fiscal stimulus. Now, is there going to be some sort of private sector investment boom, either from the repatriation of capital or through some other mechanism? I don't think so. I don't think we see evidence of that. I don't think that's what we've seen from previous similar tax cut episodes. Many promises, no doubt, will be made. The reality, I think, will be largely illusory. So that's not a positive for the baseline. Deregulation, that's going to be a big topic as well. There's going to be a lot of talk about that. And yes, some oil pipelines are being allowed or facilitated, and perhaps there'll be some other changes of rules relative to climate change, for example. I don't think deregulation for the non-financial sector at the national level is going to have a lot of impact. I don't think those regulations are as onerous as claimed, and a lot of the more difficult regulations are actually state and local regulations, not federal. There is going to be a significant impact on the financial sector. I think you should expect almost all of the Dodd-Frank financial reforms, that's the legislation that passed in 2010, post-crisis, almost all of that will be either stripped away, actually repealed, or the regulations will be substantially weakened, or a lot of it will be simply not implemented by people who are appointed by President Trump. And over the next 2 years, he will have the opportunity to appoint pretty much everyone who's significant in that space. Now, you should expect financial deregulation to lead to higher leverage, more risk-taking. Some people, including people on this call, might enjoy that, might do very well out of that. My expectation, though, is what we'll end up with is greater economic volatility. We may go up a bit in the short term, but we're also going to have some downs. And when we look back over 5 or 10 years and evaluate it, we'll be saying, yes, we got the volatility. Did we really move our medium-term growth through financial deregulation? Well, it's not what happened last time. Last episode ended very badly. That was the financial crisis of 2008. So I think we're going to rerun some version of that rather difficult history. Now, what about the rest of the world? How should we adjust the baseline, again, since developments of November, and particularly the Trump factor and the reaction to Trump? Well, Brexit is obviously the big theme for Europe. That's still playing out. I think the British are going to withdraw almost completely from the European Union. Are there other possibilities? Yes, there are, but there's more downside risk than upside risk there. And this is combined with, I think, continued important concerns about decision-making within the euro area, particularly around the financial sector, particularly about how to deal with both obvious problems in the banking system and with any kind of issue that may develop, for example, around the Italian banks. The story from Japan is the same story from Japan that we've had for many years now, pretty flat, slightly positive growth, very doubtful of get over 1%, and of course a longer-term demographic decline, which seems to be very difficult to avoid. Emerging markets, well, these are important. Remember, I think that the big dynamic of the past 20 years has been about the rise of these countries and about putting them on the path to stronger economic policies, more resilient economic growth. So, here comes a bit of a stress test. Russia, not the most important economy, but one that you're going to hear a lot about. It's a commodity producer. They ride the price cycle. They're not a big player in the global economy. They're not also a force for stability. So to the extent that there may be instability arising from Russian political or economic actions, that's something to keep an eye on. China obviously is the big story in emerging markets. China has had, as you know, export-led growth. That is going to face more friction than in the past. That's the Trump impact. Their financial system needs cleaning up. They may be able to switch more towards domestic-led growth. They need to have some changes in how they run their domestic finance in order to really make that feasible and sustainable. They do have a strong public sector balance sheet, so that's a major positive for them. India, as I'll mention in a couple of minutes, India is the growth miracle that we're waiting for. We're still waiting for. Some of the promise, I think, associated with Narendra Modi has been, disappointed or we're still waiting to see what happens. I think the latest measures taken by the federal government, including this rather strange withdrawal of some their paper money, demonetization as they call it, this has not been particularly helpful for private sector development, and we're still waiting for stronger, clearer, more stable pro-business policies there. Brazil, a very important economy, again, in an up-down, boom-bust cycle, and I wish I could tell you something more optimistic or something different about that. Now, I'm not going to go through this slide in tremendous detail. It's just to tell you, or to point out that there is a lot of potential for convergence, meaning per capita incomes rising up to the level of, let's say, the United States or Western Europe. That's been a big success story over the past 50 years. Look at Spain, for example. In 1961, it was between 10 and 20% of U.S. income per capita. That's what those numbers tell you on the right. By 2011, which this is very careful work done by the World Bank that allows us to make this kind of comparison, they had reached 65% of the U.S. level. So that kind of success, for example, in Western Europe, Portugal will be another story. That's the kind of success that we would like other countries to be able to experience. And we have had some successes away from Europe. South Korea is one I would highlight. 6% of the U.S. income per capita level in 1961, nearly 60% in 2011. So China, if you go down a bit lower, China has had a remarkable period of growth since 1978. They are now 20% of the U.S. income per capita. Could they go higher? Yeah, absolutely. Could they go up to South Korean levels relative to the U.S.? Without question, they could. Absolutely. Could they get to the U.S. level? Well, that's a different and more difficult question. But that suggests a lot of upside. And then look at India. India is at half of China's income per capita, and I'm looking at the purchasing power parity version here. If you look at the exchange rate version, you see it's even lower. So what if India could just rise to China's level? Or what if India could get to Malaysia's level in terms of per capita income? Well, again, that will be a dramatic improvement in living standards for millions of people. It will be a major reweighting of the world economy, further reweighting towards emerging markets, and it will be a transformed world by 2050 or later, for example. I'm also mentioning other countries here, important countries in Africa, for example. Don't have time to talk about them in the main presentation, but I'm happy to come back to that. Again, lots of upside potential. And just if you prefer a visual to the numbers, here's the visual on South Korea. So South Korea was a poor country by any measure in the 1950s, unambiguously, very, very poor. There were people who looked at South Korea and Ghana. This is why I use this comparison. It's a famous comparison. There were some experts who said, well, looking at South Korea and Ghana, we think Ghana is going to do better than South Korea. Well, that's not what happened. South Korea had the success. South Korea converged towards the U.S., and you can see this is the point about South Korea reaching 50% or 60% of U.S. income per capita levels. So a very reasonable, practical question is, who can do what South Korea did? Now, this is where the worries and the reservations have to come in, particularly with regard to the Trump era. This is a nice graph taken from the Wall Street Journal. They measured global trade, the amount of global trade, relative to global gross domestic product. It's an index, 1950 equals 1. But what it shows you very nicely is several phases. One, 1950 to, say, early, mid-1970s, where global trade rises from 1 to 2 times global GDP. Then there's a flat period. In the 1980s, there was a lot of protectionism, and there was some major macroeconomic problems behind this. But then you see in the 1990s a big period of trade liberalization. This is when we had the Uruguay round, and this is the creation of the World Trade Organization as part of that. So look at how the ratio of trade to GDP goes up from 2 to 3.5. But also look at what's happened since the financial crisis. Financial crisis, obviously, that very sharp dip after the 2007 marker. This index is flattened out. Now, this chart the journal published last year, and they've got 2015 TPP agreement reached, they were arguing that this could push trade higher relative to GDP. I don't think that's going to happen anymore. The major largest economy, the U.S., just pulled out of TPP. So trade is not likely to be as much of a driver of growth, as much creating opportunities for growth as we've seen in the recent past, meaning since World War II. Now, how much does trade matter for growth? Yeah, there are many ways to grow, and larger economies do not need to rely on trade as much as smaller economies. But here's a dramatic contrast between, which just shows you the outcomes of the different strategies in emerging East Asia, so that's South Korea, Taiwan, Hong Kong, Singapore, and so on, and Sub-Saharan Africa. You can see that East Asia was not a particularly big export country relative to the world in the 40s, 50s, into the 60s, and that changed from the mid-1970s. Now, you might say part of the Trump policy mix is the reaction to those countries and to their exports and to their corollary of that, which is what's happened to manufacturing in the United States. I'll come on to that in a couple of slides. Nevertheless, this has been a big provider of opportunities, an important way countries have grown, and this is going to be harder to do. Similarly, this is a chart showing the value chain, and very nice work done by Justin Lin, who was previously chief economist at the World Bank, a Chinese economist, one of the leading economists in China. And he's pointing out that from 1985 to 2008, over this 25-year period, Singapore, Taiwan, South Korea moved up the value chain, as he classifies it, towards high tech, whereas countries like Ghana, Kenya, Mozambique, others in Africa, which export, primarily they exported commodities in the mid-1980s, they primarily export commodities and some other lightly processed goods today. So that, it's not just about the amount of trade, it's what you can trade, it's can you move up the value chain, can you increase productivity, as you do that, can you raise wages and living standards. Now, India, I think, is a particular, should be a particular focus, and we can talk more about it if you want. I'm optimistic still about India and India's prospects, and I think in part that's because you look back at China and look at how China managed to develop after 1978. It wasn't all in one fell swoop. There were many problems along the way. There were many policies that were not pro-business, and this graphic is a nice one that juxtaposes some measures. Of course, it matters when you choose your starting dates and so on, but at least it's plausible to argue that India could turn out to be on a track that's similar to that of China. Now, India probably will be classified as being less export dependent throughout this path than China. But look at exports of goods and services. That's the second graphic there. Yeah, actually, the increase in exports and where they are in terms of share of exports is pretty similar in India to where it was in China, depending on when we pick our starting points, looking back historically. So if India can grow, will grow, how much of that is going to be slowed down by what's happening to trade? And just to sort of move towards the conclusion, and not to belabor this point, but I think we must always remember what is happening in the background, away from the economy, at least one step, with regard to population. This is the annual rate of growth for world population at an annual rate. You can see that a couple of things we know for sure. We don't know how many people are going to live on the planet in 2100. We are pretty confident that world population growth has already peaked. It's coming down, but it is still at a very high rate of growth compared to almost all of human history. Not since 1950, we've come down to those levels, but even later this century, we're going to still be at levels that prior to 1850 the world had not experienced. And I hope you can see the full slide. We're pretty confident we'll have at least 10 billion people on the planet in 2100. I think 12 billion would also be a completely realistic forecast. So where are those people going to live? Well, in the UN's projections, there are about 1.2 to 1.3 billion people living in what they call more developed countries. That matches up with what exactly with what the IMF calls their advanced economies. That was back in my world economy slide. So 1.3 billion people, let's say, now, 1.3 billion people in those countries in 2050, and 1.3 billion in 2100. That's important. Some countries get bigger, some get smaller. U.S. expands, some European countries, Japan contracts, but 1.3 billion total. That means, if these projections are all right, that all of the incremental additional population is in what today we call less developed countries. They will have between 9 and 10 or 11 billion people in 2100. That's the demographic. That's almost certainly, with a narrow band, but that's what's going to happen. A much larger population than what we have today. And if you look through the columns, you see some of the notables. India will almost certainly be the largest country in the world by population. China will come down to about 1 billion. Nigeria, these numbers are very controversial. Nigeria may get up towards 1 billion people. Sub-Saharan Africa may be approaching 4 billion people. So what happens in this world, these two worlds? One that is rich and resilient and is going to, I think, not be massively impacted by Trump or Brexit or other things. And this other part of the world that's much less resilient, that has much weaker institutions, much weaker property rights, much more political instability, much more conflict. Are there any technologies coming that we think would impact this? Well, yes, actually, I think there's two main technologies, and I'll touch on these briefly, and we can discuss them more if you're interested, and we're doing a lot of work on these at Sloan, and I'd be happy to engage you with some dimension of that also. But the first technology worth discussing is the so-called blockchain, which is a rather loosely used term at this point, but it means a set of decentralized technologies inspired by at least the way that Bitcoin operates, with a completely decentralized encrypted ledger. There are various other versions that are not as decentralized, and I think some of those are likely to become more prevalent. The basic idea is that you can use some less centralized technology for payments, for record keeping, for financial transactions. This could perhaps reduce problems with government, particularly when there's government bureaucracy or government corruption. It could cut out various private sector monopolies or problematic behaviors. It could allow, for example, a lot more financial inclusion in less developed countries. And I think there's a fascinating set of issues there, and these are issues that we're exploring in our digital currency initiative at MIT. House of the Media Lab, there's a big Sloan School component. We have a lot of students and others engaged with this, looking at pilot projects, working with governments, working with established companies and with startups. Some of this technology is going to be important. I do think there will be a version of a central bank issued digital currency. We can talk about that if you're interested. But I wouldn't want to exaggerate how much is going to change. I think that we are not going to move to a fully decentralized economy anytime soon. There will be a so-called trust perimeter. Who decides who's within that perimeter, who gets what value from being inside that perimeter, and what that means for economic transactions is exactly what we're trying to work out. But this is going to be lining up, I would say, very much with our existing underlying economic and political institutions. We in the United States will take more advantage of this technology than will countries that are very poor, that are badly run, that have a lot of corruption, and where the court systems don't operate. So this technology, if you like, tends to exacerbate the differences between rich and poor countries in the world. Second technology that I think is tremendously important for this outlook is artificial intelligence. Now, David Autor in the economics department at MIT has done outstanding work looking at the effects of automation over the past 30 years on jobs and on the job market in the United States and in other countries. The major impact of that has been job polarization, meaning that middle skill, middle income, middle class jobs have been pushed down, they've disappeared. A lot of those people have been pushed down into lower income employment. They still work, but at lower incomes. Highly educated people, like, for example, most of the people I think on this call have done very well, including from that technology, including using this laptop that I'm using in my living room, as you can see, to have this conversation with 250 of you around the world. So what should we expect from the next wave of artificial intelligence? Well, we're actively working on this. We have a big research and teaching project at Sloan on the global implications. And ask me again in April and May when we've done more work on this, and we're running a prototype course that will explore a lot of this and pull in leading technical people as well as people in the private sector working on these issues. My first cut on this will be, again, it exacerbates the differences between rich and poor. This time it's between the rich and poor in the United States. And maybe rich and poor is slightly the wrong term. It's the well-educated people with strong general human capital, many of whom happen to be well-to-do and to come from well-to-do families. Lower income people, less education, less access to forms of learning that will be effective going forward, they are not necessarily going to benefit from this technology anywhere near as much. I don't think the jobs are going to disappear. I think the jobs will change, but I think the jobs at the high end will become better paid, and the jobs at the lower end will get squeezed and pushed down. So add that to the Trump equation. Unless you think that protectionism is going to turn back the tide of automation, and I see no reason why it would. This automation is a totally different process. Protectionism and trade is contributed, but a relatively small amount, and it's now become the scapegoat. So if protectionism misses the point, automation is the major driver. Automation will continue this polarizing effect. Then I think the politics of the United States and likely other richer countries continue down the path that we've experienced over the past decade, which is not a path conducive to, I would suggest, a lot of stability or necessarily high rates of economic growth. I don't think these countries face the prospect of imminent decline, but we're talking about the world economy, and we're talking about who can grow and who can pull the world economy up. So you can see why I'm less than fully optimistic right now. Last slide, just to mention the span. I was trying to cover a lot of ground in 30, 35 minutes. This is what we do in the Global Economics and Management Group at Sloan. We try and work on the big picture, and we have people like Christian Forbes, who's currently at the Bank of England and the Monetary Policy Committee, but she'll be back soon. Athanasios Orphanides, he's a former member of the Governing Council of the European Central Bank, teaches some great courses on these broader macro issues. We also have people who work on more project-level courses, such as myself. Valerie Karplus works on energy. Greg Distelhorst works on supply chains. And Yaxing Huang is one of the world's leading experts on China and what is and is not happening in China. So we try to put these pieces together. We try to create a mix of material and opportunities for our students. And particularly, if I could leave you with one word, it is projects. We are always looking for projects where our students who understand the technology, who get the big picture, who have very practical skills, projects where they can work with people like you, actually, in various kinds of teams and formats, whatever could be helpful to you. I think engagement in this form is increasingly important. And I think actually it's become a mainstay of the program, all our programs at Sloan. And we want to do more of it. So if you've got ideas, if you think we're missing something, if you think there's a technology that's coming, or if you think you have applications that should interest us, fascinate us, scare us, or inspire us, let me know. We'd love to have this kind of engagement. Come visit us on campus. We have activities every week during the semester, almost always something going on that we can engage you with. Or let's talk again in this kind of remote mode. Let Renee and her colleagues know what you would like to talk about, and either I or someone else from the GEM group would be happy to keep this conversation going. And with that, let me turn it back to Renee to handle the question and answer.
Fantastic. Thank you so much, Professor Johnson. So much information, and we have a lot of questions starting to come in. Again, as a reminder, if you do have a question for Professor Johnson, please enter it into the Q&A tab in the bottom right-hand side of your screen. The first question is from Constantine, and he asks, given blockchain's rise, how would governments track and tax income, and how will that affect populations dependent on those taxpayer-funded programs?
So that's a good question. So obviously, many forms of blockchain can develop, and there are, fully, let's say, anarchic versions where people are transacting away from any kind of government control, government oversight, and you can potentially bypass the tax system if you do that. However, in countries with relatively well-run institutions, including tax system, like the United States, it's going to be quite hard to avoid taxes in that way. And I don't think you're going to see hollowing out of public finance through that mechanism. In other countries, in poorer countries, you might actually see more erosion of what flows through the public accounts. There are some better ways, we think, to design public finance, to both manage public finance and to have a stronger income stream for the government. It's not clear if governments are going to be able to adopt that, if they're going to want to adopt that. I'm talking about poorer countries now. But I would not worry about that particular dimension for the United States or Western Europe.
Great, thank you. We have a question from Timur that will continue down the tax avenue. Timur asks, on one hand, President Trump is forcing corporations to keep jobs in the U.S., and on the other hand, promising tax breaks. Are taxpayers subsidizing American jobs?
Well, the subsidy to American jobs is going to come from protectionism. So you're going to pay more for imported goods. That's what protectionism means, than you would otherwise. And that will, to some degree, serve as a pretty inefficient subsidy for some American jobs. Again, that's the basic structure of protectionism. Now, on the tax breaks, I think that the key point there is the incidence of taxation is shifting from shareholders and from wealthier Americans towards who else is there? Everybody else, right? So that shift in, how you feel about that is up to you, but that's an incidence shift. Will there be a growth impact from that? I don't think so. And I wrote a book that dealt with this, White House Burning, which looked at the Bush tax cuts and other episodes in U.S. history. I think a lot of that history is quite relevant today. So that's what I have to say on tax breaks. On the corporation staying in the United States, this is interesting because it's obviously something quite new. I'm not convinced that it's really going to have much effect. Yes, at the headline level, sure, nobody wants to be confronted by Mr. Trump on Twitter. Now, that would be a CEO nightmare. But does that encourage you to invest in the United States? I'm not sure. I think maybe investment, but create jobs. Well, again, automation is the major driving process. Automation across retail, driverless cars, so 3 to 5 million jobs as drivers could be eliminated over the next, say, 15 years. That's entirely plausible. Our company is not going to invest in automation because Mr. Trump says this, that, no, I don't think so. I think his focus, his anger is against the so-called moving jobs. I'm not sure that the company's moving jobs is the big dynamic here. I think it's automation.
Great, thank you. And continuing down the theme of kind of shifting the way things work, Gothanath asks, how does the cutting out of the middleman in government square with the rise of nationalism? All
right, so the idea of cutting out the middleman is that, well, you know this, that we have lots of inefficiencies because there are monopolies. So if you want to buy and sell a house, you have to go through a centralized land registry, which may operate relatively well, for example, in the United States, but it may be very corrupt and subject to all kinds of inefficiencies and other problems in other countries. So what if we could have a less centralized or even fully decentralized way to handle those transactions This is something that Hernando de Soto, whose name you may know, associated with stronger property rights for poorer people in Latin America, he's a big proponent of this. For example, he thinks it's going to make it easier to build a middle class, which owns property, which can borrow against its property, which can use that money to invest in businesses, and you can get economic growth that way. So that's a vision. I'm in favor of that vision. I'm a little skeptical based on what we've seen about the extent that lower income countries with weaker institutions are actually going to be able to implement that, or the extent we'll see it develop. But we're working on it, and I don't want to prejudge anything. I think technology of this kind has transformative effects that we can't fully anticipate. Now, on the nationalism, I think you put your finger on the issue at the moment. This is a moment of nationalism, and if you look not just at the US and the UK, look at France, look at the Netherlands, look at Italy, maybe even look at Germany, nationalism is on the rise. Nationalism, not of the 1930s variety, I think and I hope, but nationalism of the protectionist variety, of the let's trade less, let's protect our own jobs, let's not try and help the world to grow in order to help ourselves, but let's focus on ourselves first and foremost, and what happens to the world is purely unintended consequences. That's a big, dramatic shift, and I don't think it's a short, fleeting moment, in part because of the job polarization points that I made towards the end. So I'm very worried about the implications of modern economic nationalism for the global economy, for global growth prospects, and for the 9 billion people, 10 billion people who will be living in low-income countries at the end of the century.
Great, thank you. James is asking about that he hasn't heard you yet speak about the massive challenge of global climate change. Do you expect climate change will have a fundamental impact on your outlook?
Yeah, so you're right. I didn't mention global climate change. I just didn't have time to pack it all in, I suppose. And I think this is going to have a big impact, particularly on low-income countries. I think they're going to be much less able to deal with the kinds of weather events we would like to experience with the rising sea level, with other impacts of climate change. Now, if you really want to be concerned about global climate change, you should invite John Sternman to come speak to this group. He has a much more dire view. I'm laughing only because it's so dire. I don't know what else to do. I'm not quite in that camp, but I do think it's a very serious problem, and I do think there's tremendous negative impact coming to lower-income communities around the world.
Christoph would like to ask, why did stock world markets react quite positively on the election results in the U.S., even though all experts now expect lower growth in the U.S. and the rest of the world?
Yeah, look, that's a really good question. And I thought the stock market would have a negative response based on the policies, and I was wrong. So, it tells you should never forecast stock prices. And you notice I didn't forecast stock prices. I don't think I mentioned them at all in today's presentation. Clearly, part of what happened in the immediate post-election reaction was calculation that financial deregulation is going to push up profits at banks. I think that's true in the short term. Notice there's a news story, I think it's today, that leading executives at leading U.S. banks have cashed out. They've sold stock, gone to cash at a higher than usual level post-election, which suggests, typically, as you know, when executives sell out, that's a signal they think the price is pretty high relative to their expectations. Of course, they may be wrong too. Energy sector has also gained. Energy sector is expecting, fossil fuel energy is expecting deregulation, easier to drill, easier to build pipelines, and I think that's realistic. How much impact that has on their profits remains to be seen. Globally, I think the picture is much more mixed, and would not at all surprise me or other commentators if there was some stock market reaction. Downward adjustment still to come. But I think, we should always approach stock prices in a relatively cautious way and make our own investment decisions based on, the various parts of our portfolio. It is hard to predict how stock markets will react. But I don't see, happy to be contradicted now or send me thoughts separately by email if you want. I don't see where the big drivers for growth are going to come that would imply larger, consistently sustained corporate profits.
Got it. So you touched on a couple specific industries, but how do you expect a Trump policy would impact entrepreneurship or small business in the U.S.? And that question comes from Gene.
Well, the rhetoric is obviously going to be pro-entrepreneurship and pro-small business. There's no question. I don't see any reality yet that's particularly favorable to that sector or to those kinds of firms. So there's going to be some reduction in corporate taxation. There's going to be some shifting of the incentive tax from shareholders to other people. Okay, so that may be a little bit helpful on the margin. Does it encourage a great deal of business formation? I don't think so. What about financial deregulation? Does that will have an impact on financial markets, and that's probably part of also what's feeding into expectations on stock prices. But is that kind of financial deregulation really going to help investment, really going to help the non-financial productive sector? I don't think so. I don't think that's what we've experienced in previous deregulation-induced or deregulation-fueled financial booms. I think actually what happens at the other end is some sort of credit crisis, and those credit crises are very bad for the non-financial sector. Entrepreneurship and small business got crushed in 2007, 2008, 2009, and I'm worried about over the cycle. Maybe we get some temporary boost. It's possible, maybe, but I'm worried over the cycle, smaller business could actually take much more of a hammering. The people who are making decisions right now in Washington are almost all drawn from the large business sector. A couple of exceptions, but most of them are on the side of big business. And what big business wants is not necessarily always what smaller business wants, what startups want. So we'll see.
Great. Ellen would like to know, will central banks be compelled to keep low interest rate environment given debt levels and low growth? Well,
the central banks, let's differentiate. Central bank in the United States, Federal Reserve, is certainly going to raise interest rates. They think the economy is close to full employment. They see a fiscal stimulus coming. They don't want inflation to get out of control or inflation expectations, as they would call it, to become de-anchored. So they're going to be raising rates. What happens in the UK? Well, that's going to depend on Brexit. To the extent that breaking those trade ties contracts the UK economy, yes, their monetary policy, you would think, other things being equal, would remain relatively loose. They perhaps have to worry about where the pound goes, but on the other hand, some further depreciation of the pound would help get growth back. European economies, euro area, big question there. I think they are the ones that are going to worry about debt levels. They're going to worry about the banking system. They're going to worry about public finance, and they're going to be reluctant to tighten. Japan, I think reluctant to tighten, characterize that also. So what's the impact on the rest of the world? Well, typically it's what happens in the U.S., and typically those rates are what impact other central banks. Now, this is going to depend on how they want to play it relative to the exchange rate. Are they willing to have some depreciation? Are they concerned about that depreciation becoming inflation? But I think you should expect for the dollar block countries, or countries that are close to the dollar, trade a lot with the U.S., where financial markets and other indicators tend to follow the U.S., they will be on the tightening side of the interest rate cycle now.
So Cheng would like to know, with taking the U.S. Deficit, and how you think that the U.S. Government deficit is going to play out and how it will affect the dollars and world economy.
So this is a good issue. It's in the news this week because the Congressional Budget Office came out with its latest forecast. And this is before we do any kind of tax cut. We've got some substantial deficits, rising government debt level. Next couple of years, not so bad, but out 10 years beyond that, the numbers are quite striking. I think the Trump policies, like the Reagan policies of the early 1980s, they'll be strong on the rhetoric of a balanced budget, but the reality will be larger deficits. That's the tax cut. and they won't get much more revenue. Again, that's the reality of what happened under Reagan. So I think the gamble is tax cuts give you growth, and that helps the budget. The reality is you don't get the growth. So at the end of the day, you have a larger amount of debt. Now, that's not necessarily destabilizing. As you know from the experience over the past decade, it depends on what the global demand for that debt is. And that's a complicated calculation, including you've got to take a view on China. How much savings will be in China? How much of the savings do the Chinese authorities, or the private sector, but mostly it's a decision made by the government, how much do they choose to hold in dollar-denominated assets, including in U.S. government debt? You have to solve that global dynamic portfolio question for them, for the oil-exporting countries, for Japan, a few other places. Overall, I think interest rates are going to go up. I think it's very hard to keep interest rates low at the long end. Now, short end is obviously the Federal Reserve. The long end is traditionally much more market determined. I think the Fed will back away, has backed away from quantitative easing, so that the long rate remains much more market determined. Long rate is going to tend to go up. The yield curve may steepen. That would not be a big surprise also at this stage in the cycle. To the extent that Mr. Trump's protectionism reduces exports, reduces current account surpluses from these emerging market countries, that reduces the savings available to buy U.S. government debt. That is going to tend to push up interest rates, all other things being equal. So overall, I think there's pressure for rates to rise.
And continuing somewhat along that same vein, Kent would like to know if you believe that the Federal Reserve Bank's easy money policies have increased the growing wealth gap in the U.S.
Okay, well, that's a important and difficult question, somewhat emotional question, actually, sometimes in policy circles. The question is obviously the counterfactual. If the Federal Reserve had not engaged in that monetary policy, what would have happened to the real economy? And I think if you go back to 2008, 2009, 2010, the Fed's attempts to stabilize the economy were helpful. They did reduce the size of the recession. They reduced the job losses. And that, I would say, is good for a lot of people in the United States and around the world. Subsequently, you can argue about both whether quantitative easing was effective in terms of macroeconomic impact and whether it had what I think would have been unintended consequences on the distribution of income. Maybe at the margin, I think the Fed was just trying to keep the economy going, and the recovery has been anemic, as I said, really one of the weakest recoveries that we've ever experienced. So I'm fairly sympathetic to the Fed. I mean, I think they in no way want to repeat this kind of policy ever. They can avoid it, and that's why they have come, with some reluctance, but eventually come around to the view that financial regulation is helpful for macroeconomic stability. Now, of course, financial regulation is going to substantially go away. In various mechanisms will ensure that it goes away. So that says we're back onto the path to what? To some growth, maybe some boom-bust type cycle, but then you get the bust, then you have a crash, then the Federal Reserve engages in quantitative easing, and that has, well, maybe it saves the day, but it has the consequences for inequality that you're pointing to. So I think we're going to run another version of the same cycle. Again, same cycle meaning the one that ended in 2008.
Thank you. And now we have a kind of doubled up question from both Lewis and Ashish. Lewis asked if bringing back manufacturing jobs to America a step back down the economic growth ladder. And Ashish asked, can manufacturing really be brought back? And this is our last question.
Well, it's a good question to end on. That's really the question of the day and of the week. So again, I think the best work on this has been done by David Autor and a number of colleagues. Doron Acemoglu in MIT Economics has also got some really, really good work on this. And there will be jobs in manufacturing, even if we have a lot of automation. Now, that combination of statements implies, I think, that there won't be a lot of jobs in manufacturing. Will the jobs come back in the sense of the low-income jobs that we had in textiles or in electronics or in heavy industry, are those literally going to come back to the United States, disappear somewhere else, reappear in the United States? That seems very unlikely. If you look at the analysis and discussion of what the automakers are going to do, this is obviously in the papers today, given that they just talked to President Trump about it, they'll invest in the United States. They'll build cars in the United States. Are they going to add a lot of jobs building those cars? No, I don't think so. I think it's going to be a lot more automation, and automaking is already more automated than some other parts of manufacturing. And that kind of automation and artificial intelligence is going to spread. It's going to spread through outside of manufacturing also. So manufacturing employment that came down a lot from the mid-1990s to the post-recession levels, it has stabilized since about 2010, 2012. It probably stayed about the level that it's at now. I don't expect there to be a big increase in that. I also don't expect there to be a big decrease as long as we stay away from financial crises, which we may not. So the manufacturing story may stabilize, but it doesn't answer the question of who gets what job going forward. And particularly the very important question, what kind of job can you get if you only have a high school education? Or if you didn't finish high school? What is there available? The factory paying a relatively high wage, maybe a unionized job, that's not going to be there, I don't think. I don't think Mr. Trump can force companies to create those jobs, and I don't think that they're going to create those jobs. Now, I do think there's other policies that you could find and propose that would help people. I think there's other ways to create a more dynamic economy. I personally think this should be a major part of what we do at MIT. I think MIT has a responsibility in some broad sense to think not just about the business side of technology, but also the policy side of technology, the entrepreneurship side of technology. We do that. And then how that entrepreneurship creates jobs and how those jobs come back to benefit as many Americans and as much of the world as possible. So, I think that this is the challenge of the moment, and I think it's a sensible and appropriate challenge. I am, in case you didn't get it already, in the group of people who are skeptical about Mr. Trump and Mr. Trump's policies, and particularly this emphasis on protectionism. I don't think that's going to improve the situation. I think we're going to be still having this conversation about the medium-term issues and job polarization in 3 years, 5 years from now. Hopefully the conversation will become more productive. I fear that it will become more dramatic, and we'll be talking about more political difficulties and more problematic policies. But I hope I prove wrong on that. Anyway, I think we've run out of time, and I want to thank everyone very much for participating in this. We look forward to receiving any additional questions. If the things that I didn't touch on, send them to me or Renee, and we'll do our best to post some answers quite quickly. And I hope to see you again soon, either on campus or in another one of these events. Renee, over to you.
Thank you so much, Professor Johnson. That was an incredible conversation, and thank you to all of you for joining in on the conversation and being so active. There were a lot of questions that came in, and not all of them did get answered, so we'll be getting those over to Professor Johnson so he can work on some answers for everyone. But we look forward to seeing all of you in the coming months for our future programs. Make sure to keep an eye out for the invitation to join alumnus and Professor Nelson Repenning on February 28th as he presents his research on dynamic work design. And on March 23rd, we have MBA 2006 alumnus David Beck, the Chief Strategy and Ventures Officer for TBS and TNT of Turner Broadcasting, as he talks about the changing role of media. As this event closes, we will ask you to complete a short survey that'll pop up in order to help us create programming that will be the most impactful to you. Until next month, thank you so much for joining MIT Sloan Alumni Online, and we look forward to talking to you again soon.